part of September and spread to many countries that had not yet been touched by it, which led to grave concerns about the stability of the global financial system. Failure to prevent an international financial collapse would almost certainly have had dire implications for both the U.S. and world economies. Fortunately, the existence of the TARP allowed the Treasury to react quickly by announcing a plan to inject $250 billion in capital into U.S. financial institutions. 9 large institutions received the first $125 billion, and the remainder is being made available to other banking organizations through an application process. In addition, the Federal Deposit Insurance Corporation announced that it would guarantee non-interest-bearing transactions accounts at depository institutions and certain other liabilities of depository institutions and their holding companies. And the Federal Reserve expanded its provision of backstop liquidity to the financial system. These actions, together with similar actions in many other countries, appeared to stabilize the situation and to improve investor confidence in financial firms. Notably, spreads on credit default swaps for large U.S. banking organizations, which had widened substantially over the previous 2 weeks, declined sharply on the day of the joint announcement. Going forward, the ability of the Treasury to use the TARP, capital injections under the TARP are continuing to bring stability to the banking system and have reduced some of the pressure on banks to deleverage, 2 critical first steps towards restarting flows of new credit. However, overall, credit conditions are still far from normal, with risk spreads remaining very elevated and banks reporting that they continue to tighten lending standards through October. There has been little or no bond issuance by lower-rated corporations or securitization of consumer loans in recent weeks. To help address the tightness of credit, on November 12th, the federal banking agencies issued a joint statement on meeting the needs of credit-worthy borrowers. The statement took note of the recent strong policy actions designed to promote financial stability and improve banks' access to capital and funding. In light of those actions, which have increased the capacity of banks to lend, it is imperative that all banking organizations and their regulators work together to ensure that the needs of credit-worthy borrowers are met in a manner consistent with safety and soundness. As capital adequacy is critical in determining a banking organization's ability and willingness to lend, the joint statement emphasizes the need for careful capital planning, including setting appropriate dividend policies. The statement also notes the agency's expectation that banking organizations should work with existing borrowers to avoid preventable foreclosures, which can be costly to all involved, the borrower, the lender, and the communities in which they are located. Steps that should be taken in this area include ensuring adequate funding and staffing of mortgage servicing operations and adopting systematic, proactive, and streamlined mortgage loan modification protocols aimed at providing long-term sustainability for borrowers. Finally, the agencies expect banking organizations to conduct regular reviews of their management compensation policies to ensure that they encourage prudent lending and discourage excessive risk-taking. Thank you. I'd be pleased to take your questions.
Chair of the FDIC, Gilbert.
Thank you. Chairman Frank, Ranking Member Baucus, and members of the committee, I appreciate the opportunity to testify on recent efforts to stabilize the nation's financial markets and to reduce foreclosures. Conditions in the financial markets have deeply shaken the confidence of people around the world in their financial systems. The events of the past few months are unprecedented, to say the least. The government has taken a number of extraordinary steps to bolster public confidence in the U.S. banking system. The most recent were measures to recapitalize our banks and provide temporary liquidity support to unlock credit markets, especially interbank lending. These moves match similar actions taken in Europe. Working with the Treasury Department and other bank regulators, the FDIC will do whatever it takes to preserve the public's trust in the financial system. Despite the current challenges, the bulk of the U.S. banking industry remains well capitalized, but what we do have is a liquidity problem. This liquidity squeeze was initially caused by uncertainty about the value of mortgage-related assets. Since then, credit concerns have broadened considerably, making banks reluctant to lend to each other and to lend to consumers and businesses. As you know, in concert with the Treasury and the Federal Reserve, we took a number of actions to bolster confidence in the banking system. These included temporarily increasing deposit insurance coverage and providing guarantees to new senior unsecured debt issued by banks, thrifts, and holding companies. The purpose of all these programs is to increase bank lending and minimize the impact of deleveraging on the American economy. As a result of these efforts, the financial system is now more stable and interest rate spreads have narrowed substantially. However, credit remains tight and a serious threat to the economic outlook. Regulators will be watching to make sure these emergency resources are mainly used for their intended purpose, responsible lending to consumers and businesses. In the meantime, we remain focused on the borrower side of the equation. Everyone agrees that more needs to be done for homeowners. We need to prevent unnecessary foreclosures, and we need to modify loans at a much faster pace. Foreclosure prevention is essential to helping find a bottom for home prices, to stabilizing mortgage credit markets, and to restoring economic growth. We all know there's no single solution or magic bullet, but as foreclosures escalate, we're clearly falling behind the curve. Much more aggressive intervention is needed if we are to curb the damage to our neighborhoods and to the broader economy. Last Friday, we released the details of our plan to help 1.5 million homeowners avoid foreclosure. Our program would require a total of about $24 billion in federal financing. The plan is based on a practical experience in modifying thousands of mortgages at IndyMac Federal Bank. As we've done at IndyMac, we would convert unaffordable mortgages into loans that are sustainable over the long term. The plan would set loan modification standards. Eligible borrowers would get lower interest rates and, in some cases, longer loan terms and principal forbearance to make their monthly payments affordable. To encourage the lending industry to participate, the program would create a loan guarantee program that would absorb up to half the losses if the borrower defaults on the modified loan. While we applaud recent announcements by the GSEs and major servicers to adopt more streamlined approaches to loan modifications along the lines we have employed at IndyMac, the stakes are too high and the time is too short to rely exclusively on voluntary efforts. Moreover, these recent announcements do not reach mortgages held in private label securitizations. We need a national solution for a national problem. We need a fast-track federal program that has the potential to reach all homeowners, regardless of who owns their mortgages. What we're proposing is a major investment program that can yield significant returns by attacking the self-reinforcing cycle of unnecessary foreclosures, placing downward pressure on home prices. Average U.S. home prices have declined by more than 20% from their peak and are still spiraling down. If this program can keep home prices from falling by just 3 percentage points less than would otherwise be the case, over $500 billion would remain in homeowners' pockets. Even a conservative estimate of the wealth effect this could have on consumer spending would exceed $40 billion. That would be a big stimulus for the economy and nearly double our investment. In conclusion, the FDIC is fully engaged in preserving trust and stability in the banking system. The FDIC stands committed to achieving what has been our core mission since we were created 75 years ago in the wake of the Great Depression, protecting depositors and maintaining public confidence in the financial system. Thank you.
Thank you. Before I start my testimony, I want to just put into the record a very thoughtful letter from our colleague, Mr. Kucinich, who is chair of a subcommittee on government reform, strongly arguing for help on foreclosures. A letter that was sent to me, and a letter was also sent to the Secretary from Michael Fazell, the presidential appointee to head the National Credit Union Administration, objecting strenuously on behalf of the health of the credit union industry to the decision not to buy up any assets, and also a statement from the National Association of Realtors. I will now begin my 5 minutes, and I'm going to hold everybody to 5 minutes. First, I welcome to the two chairs here the interagency statement on meeting the needs of creditworthy borrowers. It is a very good statement. It will be an even better statement if somebody gets whacked for not following it. There's got to be some teeth, and it does talk about compensation, about dividends, and it is a very good statement. I can't imagine that a month from now everybody will have complied, and so therefore, frankly, evidence that it meant something will be if there are at least some letters issued or some penalties. Secondly, I just want to report on the Oversight Board, and the gentleman from Texas referred to it. My understanding is that the Senate Majority Leader and the Speaker have appointed their members. The minority leaders have not appointed their members yet. So the board is not yet functional. Earlier this week, last week, 3 members were appointed as called for on the statute by the Majority Leader of the Senate and the Speaker. Now I want to get to the issue. Can I have that back? I want to get to the issue of the mortgage foreclosure. First, Mr. Secretary, I am going to also